Hello, hello. You're watching Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Today, I'd like to show you a few charts that tell the story of a potential supply squeeze happening underneath Bitcoin's price to help push it up. I'm really excited about the world of on-chain data, and I can't wait to show you some of it. So let's just dive right in. This first chart you're looking at today is Bitcoin futures long liquidations, courtesy of Glassnode. These are traders that bought futures contracts to bet on the price going higher, were wrong, and had their positions fully liquidated as the price went against them. You know, when the rally was occurring from February and March and April as we pushed through the 50s and into the 60s, there was an excess of leverage in the system, futures leverage. There were exchanges like Binance that were offering 100x leverage options for people participating in the derivatives market. That's an excessive, dangerous amount of leverage. I would never recommend someone trading with that much leverage, but there were people doing it. And as the rally really started to peter out and kind of flatten a bit here, we kind of saw this price evening out and flattening. There came the first of a couple of very large, long liquidation days that had a great impact on market sentiment, in my view. The first one came here on April 18th, as the price broke down out of the 60Ks. This one totaled $1.8 billion in liquidations instantly. These people lost whatever they had just taken right out from underneath them. You know, we chopped around for a few more days here. There was a suckers rally back over 55. And somewhere around in here, around May 12th, was the famous tweet from Elon Musk about Bitcoin no longer being accepted for Tesla vehicle payments. And that just created even more FUD in the market, more fear, more uncertainty, more doubt. You know, a lot of the casual retail interest that had bought up here at the highs began selling. They lost confidence. And, you know, people just bailed out of the asset because they didn't understand it. Price began selling off. And what ended up happening here, as we broke down under 40, was another day of huge long liquidations, this time to the tune of 1.1 billion. So we're looking at over $4 billion of liquidations that occurred in 1 month from April to May as price lost 50% of its value. And when something like that happens, think about what that does to the human beings participating in that market. They get terrified. They are completely wrung out of all of their excitement, their enthusiasm, their confidence. Their positions are vaporized, and they leave the market. This is not a unique event. You know, this occurs in market crashes in every asset class. But Bitcoin especially, and crypto broadly, are susceptible to this behavior even more so because of their inherent volatility as they grow, because they're a new asset class. And so, you know, when we get these huge liquidations and you get a 50% correction in price from 60K to 30K, what happens is casual interest just abandons the market. That left us with an extremely low volume, low volatility summer where many people thought Bitcoin was dead. This chart, the next chart we're going to look at, tells a bit of that story. This is the count of transactions every day on the blockchain. One thing I will point out about this chart that's different from a regular transaction count chart is that this is entity adjusted. And what that means for Glassnode is that they identify, we'll call them people on the chain based on their groups of addresses. And whenever someone moves coins between one of their own addresses, it's considered economically insignificant. And so this chart adjusts them out. What you're left with are only person to other person transactions that take place on chain, otherwise known as economically significant transactions. So why am I showing you this? Well, if you take a look here at the rally from October here all the way up into February, May, transaction counts were really spiking. You know, this is obviously, it's a volatile value, and we're looking at it here with a 7-day moving average to smooth it out. But still, you can observe generally a structural trend of sideways, a little bit of a bounce as price recovered from the C19 crash here in March of 2020. You know, it continued to spike up until at least this first rally, this first real quality pullback that we got as part of the bull run. ever since, after that moment, transaction counts never really recovered. We see a couple of spikes here. Here's some of that liquidation. Here's a bit more of that liquidation and sell off. And then we just bottomed out down here. As price got down into the 30s, it broke down below 40. The volume on chain just vanished. The interest, the demand in acquiring this asset by casual people vanished. And so all that we were left with were the BTC loyalists, the dollar cost averagers, the sat stackers, the long-term holders who intend on keeping Bitcoin for the long term. That's who was left in this market. And we saw that for a good 2 months. I mean, this whole period here is really from May all the way to August, this basin of volume. And something that I'm seeing now that's making me feel confident that perhaps casual retail interest is returning to Bitcoin is that we are seeing since the late July period here where we hit our low, that transaction counts have been slowly trending back upward and now are back to the level that they were at in mid-May. That's a positive. Why did I say that we had a supply squeeze in play? What gives me that feeling? Well, I want to give you a bit of back history. This chart is called the spent output age bands. And what this chart shows are the age of coins moving on the network each day. And they're colored by some age cohorts broken up from 1 hour to 1 day to 1 week to 6 months to 2 years, all the way up. Now, I've filtered this down to where the only activity that you're seeing, this purple and pink area, are coins that are at least 6 months old. For a coin to be 6 months old, that means that someone purchased it and then hasn't touched it for half of a year. Every time a coin moves to a new hand, its lifespan starts over again at 0. And it becomes a 1 hour old coin, and then it becomes a 24-hour old coin, and then it becomes a week old coin, etc. What we have seen with Bitcoin, and something that we've been watching for this summer, is often after there is an all-time high rally, you tend to see older coins selling into that liquidity to realize profits and reset for the next market. We saw an increase in 6-month coins being sold in this 2017 rally, but really the danger came in on the relief rally. This period here in February of 2018 came after a huge correction. Price went from 19,000 down to 6,800. That's that's like 60-70% correction. And as price rallied again on the secondary kind of suckers rally, old hands, that's coins 6 months and older, began dumping in mass. Now, why did I say earlier in the video that I felt we were working on a supply squeeze? What you're looking at here is a chart of long-term holder supply. Through some analysis, Glassnode figured out that coins that sit stationary in their wallet for 5 months or 155 days, they become statistically less likely to be sold. So they created a bucket of coins called long-term holder supply. And every day, new coins that were bought 155 days prior get added to that supply if they haven't moved. So we end up with a slightly lagging but very powerful indicator to show us the underlying supply dynamics going on in Bitcoin. So when we look at the supply of long-term holders here, you can really notice a pattern that as prices tend to break previous highs and rally, long-term holders begin exiting. Right here, this spot is where price broke the previous all-time high around like $30, $20. And as it began to break, long-term holders began exiting their positions into this rally, and they sold to younger hands. If we show you short-term holder supply, which is just everyone who's not a long-term holder, you can really see as this goes down, this increases. They are inverse of each other. They have a mutual relationship. And through each of these rallies, long-term holders have sold their coins, realized gains as we've broken the previous all-time highs, and they've sold to younger hands. This is no different here at the end of 2020. As we broke the previous all-time high, around 19,000, we really started to see long-term holders exiting their positions until sometime in mid-March when they began once again accumulating. So long-term holders are really what we would consider the smarter money. Them along with big whales, savvy investors, make up the floor of pricing for Bitcoin, and they help give us a signal about when rallies might be reaching their exhaustion point. One thing that we've noticed with long-term holder supply this year is that it is now at its all-time high in terms of nominal amount of coins that it represents. The 12,835,000 Bitcoin that make up long-term holder supply is the highest amount it has ever been. And they've been accumulating at almost rocket ship pace since March. That is extremely bullish. That signifies a hodler mentality. It shows conviction and confidence in the asset, and it tells us that there are a lot of participants in this market that are perfectly fine holding their coins for the foreseeable future, even in the face of a 30 or 50% correction in price that we experienced in June. One thing I will point out, I don't need to go back to all, we'll just keep it at 3 years. One thing I will point out is that the percent of long-term holder supply is not at the highest level it has ever been at. I should go more than 3, shouldn't I? Let me go back to 2016. There are periods of time in the past where long-term holder supply was a percentage of the supply larger than it is now. You can see back in January 2017, it made up about 70% of the supply. But something that is different about the past versus now is that long-term holders have different behavior. Before this 2017 rally, where long-term holders really dumped out of their positions in mass, they had pretty much only sold at blow-off tops. After this moment, they became much more active, kind of selling in and out of rallies. And I've done some extensive analysis on this on Twitter that I might make a video about in the future. But for now, we will just leave it at the fact that long-term holders have become more active since the 2017 bull market. They tend to sell into relief rallies, and they still maintain their conviction not to let go of coins in corrections. So they're a more resilient, more evolved holder class than we used to have. But they still represent the floor of price for Bitcoin. And the fact that long-term holder supply continues to grow shows me that there is still confidence, and we still haven't reached a point where positions are being exited. That gives us conviction for another leg up in this rally. So the next chart we're going to look at here is the illiquid supply shock ratio. This chart belongs to Will Clemente. He's another on-chain analyst on Twitter. Shout out, Will. And if you don't follow him, you should check him out. He's another person who's putting out great content in this space. And what we're looking at here is the illiquid supply. So this is a bit different from long-term holder supply. I'll explain why. So illiquidity, the determination of whether coins are liquid or not, is based on some analysis that Glassnode has performed on the entities actually holding those coins. So I am an entity. You are an entity. Elon Musk is an entity on chain. Coinbase is an entity on chain. We're not talking about Coinbase, but an entity is an individual participant in the market. Their liquidity rating is the likelihood that they are to sell their coins. A highly liquid entity is one that historically tends to sell 75% of their time. They buy, but they also get rid of a lot of their coins. They're constantly flushing coins. These tend to be the behavior that are marked by short-term speculators. Long-term holders tend to be of the illiquid variety. Illiquid entities is an entity that tends to sell less than 25% of its holdings long-term. What we can do by calling an entity liquid or illiquid is apply almost an intent to that investor as they are joining and leaving the market. And so every day when new coins are bought and they go into addresses that belong to entities that we have labeled as illiquid, we can assume 75% or more of those coins will remain where they are for the long term, and they're not likely to be sold. And so what that really tells us is that when we see a liquid supply growing, we are having an accumulation event occurring. The people buying these coins are pulling them into cold storage, they're pulling them into hardware wallets, they're taking them out of exchanges, they're doing whatever it is that they do custodially with them without the intent of selling them back onto the market anytime soon. That is good for price, because that removes the available supply for new buyers. And when supply is low and demand increases, price goes up. If you look at this chart here, now that I've explained what liquid and illiquid means, this chart is showing you, first of all, the red line here is the actual raw value of illiquid supply. And you can see generally it is trending upward, right? Over time, it tends to trend upward most of the time. When it starts trending down, that means that older hands that tend not to sell are flushing their positions into liquidity, realizing gains. We don't want to see that in a rally. In this blue line here is the illiquid supply shock ratio. And what that's showing you is the ratio of this number here, the illiquid supply, compared to the rest of the supply that belongs to the more liquid entities, that belongs to the people more likely to sell. So when we see an uptick in this blue line, in the ratio of illiquid supply, what that's telling us is that more of the supply is going to accumulators than to people who like to sell. More of the supply is being taken offline for long-term storage than is ending up with someone likely to flush it. This is extremely bullish behavior. There was a long period of time where illiquid supply was kind of trending downward and it was sideways, but we've noticed that especially in the rally here, we can see these were coins being taken offline into the rally, illiquid supply growing, and in this recovery since the crash in May, we began immediately accumulating on this value again. Something I want to note here is the divergence in the price declining from May into June and July. However, illiquid supply shock was on the increase. And when you have this wedge pattern forming, this is a bullish divergence. What this is showing is coins are being sold, they're being exited. However, the hands that we wish to remain strong, the ones that we need to stay convicted in order to ensure the rally continues, are growing their positions. They're not selling. They're not joining the sell-off. They see it as an opportunity to purchase and to grow their wealth, and they began buying the dip. This is the visual representation of long-term investors, hodlers, sat stackers, dollar cost averagers buying the dip. The last chart I want to show to really cap off this thesis of a supply squeeze is accumulation balance. What is accumulation balance? This is the amount of raw Bitcoin that exists with entities that have never once sold their coins. This also filters out lost coins that I want to add that. There's a statistical likelihood that coins that are older than 7 years are not going to be spent. And there's also a lot of coin that are lost permanently because, in the early days, self-custody and cold storage solutions and the best practices around them weren't as developed. Information about how to self-custody wasn't as widely spread. And they're just, the market was immature at the time. So there's a fair amount of coin that's just estimated to be lost forever. We exclude that from accumulation balance here. What we've noticed is really since the rally in 2018, accumulation balance has been going straight up. I zoomed in too much here. Let me stay zoomed out. Accumulation balance now makes up roughly about 18% of all of the non-lost supply. So all of the coins that are still economically relevant, about 20% of them exist in possession of someone who has never once sold a single Satoshi. That's incredible to me. This being on a perpetual uptrend is nothing but positive for the long-term health of the Bitcoin market. What we want is for long-term holders to grow their positions, pull coins out of the exchange into cold storage, and not to move them. That is what a store of value exemplifies, and that is how we will see a price rally on low available supply. When casual retail demand begins to increase here over the next few days and weeks, as we break out over 50 and we begin to approach the previous all-time high at 64, there's a very good likelihood that the low amount of available supply, as long as we don't see long-term holders turning over, we don't see older coins suddenly coming to life to realize gains into liquidity, as long as those factors remain, price is likely to continue to rise in the next few weeks and months. Probably through the end of the year, I would wager, barring some black swan event or some unforeseen selling by old hands. But, friends, we simply aren't seeing that right now, which gives me a lot of confidence in this current rally. So, with all of that said, of course, we might see a bit of short-term price fluctuation. We might bounce around a little bit in here on the way back up to 64. Well, I'm just drawing some lines, but this kind of behavior is not bad for an asset. What we don't want to see is price to just do this, because if that happens, we're going to get one of these. And so any kind of, slow accumulation like this rally has been here, if we just kind of continue this pace, that is exactly the kind of recovery that I think could lead to new highs, sometime by the end of the year. Historically, the tops of markets have been in December, but that might not hold into the future. But, depending on what we see in the charts, I will continue to keep you updated. I will make many more videos in the future, but I also want to keep my Twitter content going, so make sure that you follow me on Twitter at TXMC Trades. I post regularly. I'm really looking forward to sharing more about on-chain data with you. It's something I'm very passionate about. It gives us a window into Bitcoin that simply doesn't exist with other financial assets. So please, if you enjoy this content, make sure to like my video. It means a lot to me. Please subscribe, share it with your friends, share it on Twitter, and just come along on this ride with me while we learn together in public. I'm not an expert. I'm just a passionate, enthusiastic fan of Bitcoin and data. And so I want to share that with you. This has been a lot of fun, and I look forward to the next video. See you guys later. Cheers.